Part 1. Value Investing. Benjamin Graham and David Dodd, the core idea in the intelligent investor and security analysis. Benjamin Graham and David Dodd teach that investing is owning a part of a business. The market is a voting machine in the short run and a weighing machine in the long run. This means prices may deviate from intrinsic value due to sentiment, creating opportunities. If a company is worth $100 and trades at $60, you have a 40% margin of safety to protect against analytical errors or unforeseen events. Margin of safety: always buy a stock with a margin of safety, the difference between its intrinsic value and current price. Defensive versus enterprising investors. Defensive investors focus on stable, dividend-paying blue-chip stocks or index funds with minimal activity. Enterprising investors can analyze balance sheets, income statements, industries to find undervalued or overlooked stocks. Valuation approach: key valuation methods from Graham. Earnings power valuation, value based on sustainable earning capacity. Asset-based valuation, especially for distressed stocks where liquidation value matters. Mr. Market analogy: imagine the market as a person who offers you prices daily. Some days he's euphoric, others pessimistic. Your job is to use him, not to be influenced by him. Part 2. Growth investing. Philip Fisher's scuttlebutt method. In Common Stocks and Uncommon Profits. Fisher emphasizes qualitative analysis. Speaking to suppliers, competitors, employees, and customers to assess a company's true prospects. 15 points to look for. Some key points include: does the company have products with sufficient market potential? Does management have determination to continue developing products? Is there an above-average sales organization? Does the company have worthwhile profit margins? Instead of buying purely cheap stocks, he seeks great businesses at fair prices. For example, Coca-Cola was not dirt cheap when Buffett bought it, but its brand moat and predictable cash flows justified the premium. Focus on management quality. Invest in companies with ethical, competent, and growth-oriented management. Culture and leadership are long-term drivers of business success. Frequent trading increases costs and tax liabilities. Part 3. Combining value and growth. Warren Buffett's adaptation. For example, Buffett merged Graham's value investing with Fisher's growth approach. A key Buffett concept is economic moat. Structural competitive advantages like brand, network effects, or cost leadership that protect profits from competitors. Long-term ownership: Buffett advocates for buying companies you're willing to hold forever, benefiting from compounding returns. Part 4. Individual edge. Peter Lynch, Invest in What You Know. In One Up on Wall Street, Lynch explains how individual investors can beat professionals by observing daily life. A new fast-growing retail chain in your city, innovative products gaining popularity. Before. Wall Street notices stock categories. Lynch categories as stocks as: slow growers, be patient for the market to recognize value. Stalwarts, fast growers, cyclicals, turnarounds. Asset plays: knowing which category a stock belongs to determines your expectations and holding period. Research and patience: do your homework, understand the business model, growth drivers, and risks. Part 5. Simple, quantitative investing. Joel Greenblatt magic formula: investing in the little book that still beats the market. Greenblatt introduces magic formula investing, focusing on high return on capital, high earnings yield. Rank companies based on these two metrics. Invest equally across top-ranked stocks and rebalance annually. Why it works: this disciplined, rules-based approach avoids emotional biases and exploits market inefficiencies systematically. Passive investing. Burton, Malkiel. Efficient market hypothesis in a random walk down Wall Street. Malkiel argues that most active managers underperform index funds after fees because markets are highly efficient, pricing in all known information quickly. Index funds: for most investors, investing in low-cost index funds is the best way to capture market returns without the risks of stock picking. Diversification and time horizon: diversify across asset classes, sectors, and geographies. Invest for the long term to ride out volatility and compound wealth. Part 7. Warren Buffett's wisdom. The essays of Warren Buffett. Key principles. Business quality over price alone. Better to buy a wonderful business at a fair price than a fair business at a wonderful price. Shareholder alignment. Management should act in shareholders' best interests, reinvesting only where returns exceed cost of capital. Circle of competence. Invest only in businesses you understand deeply. Patience. Buffett's favorite holding period is forever. Part 8. Integrating all approaches into your strategy. Step 1. Know yourself. Are you a defensive investor who prefers passive index funds, or an enterprising investor willing to spend hours analyzing companies? Step 2. Combine value and growth. Successful investors control emotions during fear or greed cycles, sticking to their process. Seek companies with strong fundamentals, competitive advantages, reasonable valuations. Step 3. Diversify intelligently. Don't put all eggs in one basket, but also don't over-diversify into hundreds of stocks without understanding them. Step 4. Focus on long-term compounding. Frequent trading and speculation destroy returns. Instead, let compounding work over years or decades. Step 5. Embrace discipline and emotional control. Markets fluctuate,